More, let's bring in Nancy Tengler, CEO and CIO of Laffer Tengler Investments. All right, Nancy, jump on in. You probably caught a little bit of that previous discussion. So, I know it's not like you're going to be out of the market, but what are you doing here?
Well, Kelly, I think one clarification, I think there's a possibility that inflation will tick up, but we have been in the camp, and there are others there that have said previous inflationary periods, and there were 7 in modern history, what we've seen is that inflation is symmetrical on the way up and on the way down, but it's not necessarily linear. And that's what I think may happen, is that we'll get a surprise and the market will be caught flat-footed. That's an opportunity, we think, to go back in and buy some of the tech names that we were buying last fall, have been trimming in the second quarter, and may want to own more of as the secular narrative and tailwind of digitization continues. And we want to have more, we may want to get more exposure.
Sure. So what's on the list? Are you expecting for sure more market weakness in kind of the months, quarter or two to come?
I think it's a fair bet. We ran pretty hard, pretty fast, not just from October, but certainly year to date. I don't think stocks are frothy, but on average, every 12 months, we get a correction. Historically, we haven't yet really seen that. We sort of tried in July, first week. I think it would be healthy for the market if we got a pullback. Let people take a breath. The volume this time of year is pretty spotty. So I think that might just be a continued catalyst. And we're seeing the futures up strong almost every morning, and then a sell-off into the end. So that usually tells us that we're going to see some sort of a correction. But we think we're in a bull market. So I don't think you want to run away. This isn't. I don't think this is 2022. It's just an opportunity to reposition. And that's actually what we will do.
You are launching an ETF today, Nancy. The Tengler, I'll call it the Tengler ETF, TGLR. 25 to 30 positions intended to produce a dividend yield. And is that reflective of how is this timing coincidence or not, with kind of the outlook you foresee for these markets?
Well, I thank you for that, Kelly. I would say that August is probably not the best month to launch an ETF, but we did it anyway. It was like when I finished my book, my agent said, "Why this book? Why now?" And I said, "Because I just finished it." Right. So we're ready to go. And what it does reflect, though, is I've been managing money since the mid-'80s using this strategy, relative dividend yield. I don't have to estimate earnings because management's doing that for us through the dividend. They set it as a portion of long-term sustainable earnings power. So we get access to some really interesting names, fallen angel growth stocks that you wouldn't normally see in a dividend growth strategy. And it's worked. And so we've turned away a lot of people that don't meet our minimums. This was a way for us to provide access, and it's a core strategy. So it just made sense to us right now or next month or last month.
Right.
But certainly, yeah.
And it's also interesting because if you're expecting inflation to be a little bit sticky, I mean, that's going to have a lot to do with how attractive dividend yields are and at what price and where rates are. I mean, there's just a lot of balls in the air right now.
That's right. And remember, 9% dividend growth historically has outpaced inflation. It didn't do it last year. But if you can get growing dividends, the compounding of that and the protection in declining markets is powerful. And if you're buying companies that are already, depressed for a reason, I mean, think we were buying Apple in 2013. Yield was 3% above the 10-year at that time, and nobody wanted to own the stocks because they weren't considering services, just a handset company. Well, those are the kind of names we get access to using relative yield. It's a powerful tool. Been using it for 40 years. It still works. So we're pretty excited about it.
And then finally, if I'm not mistaken, you're still interested in some of the names like Google and Oracle and Amazon, clean energy beneficiaries, AI plays. Is it just those 3 in particular?
Well, those are important because the TAM for cloud is $3 trillion by 2026, and when we get there, we're only going to be at about 30% penetration. So cloud growth is decelerating, or at least it has been. We think it will probably accelerate some, and particularly because AI is a big demand on cloud computing. So we like those 3. Oracle's kind of the cheapest cloud AI computing platform. Oracle, their appointment of Ruth Porat, we thought was super important. And then we had compared Andy Jassy to Jeff Bezos, what Tim Cook was to Steve Jobs. And so we like that name. They did deliver on earnings this last quarter. So I'd wait. I don't think you need to chase any of these names. You wait for the pullback and then you step in and buy them. And then in clean energy, I mean, there's such a mismatch between what the administration is projecting in terms of CAFE standards, which would drive us to like 100% EVs in 2032. But we can't even produce enough of the metals and minerals that we need to produce 18 million EVs currently. So I think that mismatch will continue to be rewarded in the market. One way to play that is Albemarle, which is lithium.
Yeah.
If we were producing 18 million vehicles today, we'd be using 88% of the available current production of lithium. So we have a long way to go, but the supply-demand mismatch, I think, is going to be important to these names.
It's funny you say that. We're going to talk to Freyr later in the show. They're a battery maker. Kind of talk about the same issue between the hopes, the aspirations, and the reality for this space right now. Nancy, thanks as always for your time today.